The last time we talked through just kind of the five rules that, a little bit of detail, like what they are, how to use them, how to spot them. So I think this time we can go through and look at some more detailed chart examples. I'll pull some up that are kind of historic examples that I've traded, and I know how they work. And then Joel, you can go through and I'll try and leave them blank, as you can see, like, hey, where do you think everything should be?
Right.
So I'll pick like one or two and I'll go through just like fresh, like here's what they are. And then if you have any on your mind that you want to pull up and go through, like charts that you have questions about, we can do that. And then we can get into, okay, now that we've charted some, let's get into like actually how these would play out. So like kind of what the life cycle will be. Where would the entry be? How would you automate it? How would you manage it? Kind of an idea of where exits would be. First one, we'll go to HWM. This is Howmet Aerospace. This, I think, is a good spot right here. So we're going to look at end of 2022. So a couple of levels here, but I'll kind of walk through this. And then there's another one further up we can look at, and I'll see what you would think about it. So typically when I'm looking at charts, this is all I have. So I have the 200-day, I'm on the daily time frame. Okay. Using TradingView, by the way. On the daily time frame, all I look at is volume and the 200-day moving average. Okay. So I'm not using RSI, any of that. Okay. Right. Like my rules don't require anything else. Okay. Because, literally 100 years ago, 1920s, this is what people were using to trade the market. They were just literally using price and volume, and they were successful back then, kind of building out a lot of the systems that we still use today. So with this, the first thing I notice is when I'm looking for a trade, so I look, what is the orientation to the 200-day moving average, right? So we see here in 2022, right, like prices, it's above the 200-day, it's touching it. It can't really break out. It can't really get any higher. Okay, so I'd pay attention to that level, right? Like it's a 1, 2, 3. So this is price resistance. Like price isn't able to get above this level. That's something to pay attention to. It goes back below the 200, gets back above it, and rejects it. But then right here, this catches my attention in October. And so why is that? This is a higher low, right? So it's not doing this like big back and forth where it was here, where it was just like above, below, ping-ponging. It starts to consolidate a little bit, right? So the bounce is higher. And then notably, so we have one low here. Let's move this level. So we have one low here, and we have a lower high here, and then we have a higher low, okay? And so the important thing about this lower high is it occurs between two higher lows.
All right, guys, look, we've only just scratched the surface in this video. If you're ready to see the full detailed breakdown of this videos and gain access to the same system that allowed me to retire at 35 while working a full-time job as a management consultant, then you need to be in the Construct. Inside the Construct, you'll get access to over 100 hours of educational content, daily live streams, and my personal trading framework. Click the link in the video below to start your free trial in the Construct today.
Hey, so that's essentially like a green light. When you start having the price compress, now it's a sign that, hey, this ping pong motion, somebody has stepped in and is starting to take control. And maybe they're starting to try and guide it up. So from here, we have a level of price support around $30, 30.21. Now we have a higher low, and then there's our lower high. Okay, cool. So those are kind of the first things we're looking for: price support, lower highs, higher lows. Obviously, there's a 200-day. And so it's below it.
Right.
That means it's a reversal. Okay. So automatically you're sizing down because you're not going to have all 5 rules being met if you take an entry below the 200-day. So just know that ahead of time. It's a reversal. I have some other rules that we can go over later about like specifically how I treat reversals. And I have some rules around like how many I take. I never take more than 2 in my portfolio. So if I have 20 trades, I never have more than 2 reversals, because in general, we want to be trading strength. We want to be trading things that are not reversals. We want to be trading things that have already broken out and they're up like, 100% for the year. So quick note there. Then, so we look for our lower highs. That's where we put our trend line. So here's a high, here's a lower high, here's a lower high, and here's a lower high. So ideally, you'd connect all of those in one trend line. You can't, right? This one falls off of it. That's fine.
Yeah.
We get a nice clean trend line.
So perfect. Yep.
So yeah, in a perfect world, this lower high, the one that you would use as your entry, touches the diagonal, but it doesn't have to. That's fine.
Right.
And then look at that. You connect these lower highs, and where does it happen? Right there at the 200 day. That's why I
Yes.
wanted to pull up this chart. That's perfect because you have a break of your higher high right here. And on the same day, it crosses the trend line and touches the 200-day moving average. This is ideal because you get everything happening in one day. Everything happening at once. So
Yeah.
this would be my potential entry right here on this day, 19 October, because you get a close over this higher high.
Yeah.
It touches the diagonal. Okay, that's fine. Your entry is here. Your entry is a confirmation of the trend. We now have a higher high and a higher low that is confirmed. So you could
Right.
take your entry here, and then you'd be entering is with 3 of the 5 criteria, right? Like you haven't broken the trend line yet, and you
Right.
haven't broken the 200-day. So 3 of 5 criteria, that's a 3% trade, 3% position size. And then
Right.
if you just waited literally 2 days, 21 October, now it's rips and everything looks good. So
And then you would add the 2%.
yeah, you
If
would
you could
if
add-
you wanted to. Yeah, if you wanted to. I mean, that's kind of a big day there, right? It goes from 33 to 35. So that's a 10% day.
Yeah.
But yeah, so you would take the entry basically on the 200 cross. Okay. And so
Right.
yeah, kind of how you would play this in reality.
Yep.
I would have an alert set here on the 200-day, and I would have orders sitting, if the 200-day is, call it $34. I'd have orders sitting at 3402, 3404, 3406. Okay.
Right.
And they get filled during the day, and I would have an alert set, sent to my phone. And that's where my alerts go. My alerts come to my phone. And so when I get the alert, I'd pull up the trade, check it real quick and say, oh, okay, what is it? Cool. Where is it? And then I would instantly go ahead and set an alert for the low of day. Because your entry criteria is, okay, once this breaks, you're good unless it makes a new low. So, and think about that for a second, right? Like if you have a trade and you enter it and there's momentum and it's breaking out, but then at some point in the day it reverses and makes a new low, like it's no good. It's no longer a good trade, right? Like it has reversed and lost all its momentum. And at that point, you're out. You're done.
Right. The trade is over. So you don't have the 200-day cross yet, and you don't have the trend line cross yet. You've got a higher low. So that's one is the higher low. You've got now a higher high, which is the second one because it's breaking out. And the third one.
Price support. So it's down here.
So the price support is within range or within reach.
Yeah. And again, in a really great trade, and I've got one. Oh, I've got a good one. We'll look at here in just a minute. The price support and the higher lows and the lower highs, like they're all in a really, really tight range because those are your potential stops, right? Like all of these are stops, right? And you want them to be as close to your entry as possible. That way your potential risk is, 0.5% or 1%. Like you don't want your potential risk to be a 10% difference between where you enter and where you would stop out, because that means you have to size down. Like you want that entry, you want the difference between where you enter and where you would stop out to be as small as possible. I mean, like if you can get it to be 15 cents, right? Like a TMC, I entered that last year and my risk was like literally 7 cents. Like it was a $30 stock and my risk was 7 cents. And it didn't, so in that case, it doesn't even have to move that much, right? Like if your entry is literally 7 cents and the stock moves, 50 cents, I mean, that's a 5x on your risk right there. So like it doesn't actually have to move that much. And so that's what you're looking for as a trader. So but just because it doesn't happen doesn't mean you can't take the trade. You just have to adjust your sizing to fit that. And
so that's why one of the criteria is price support, is because that price support has to be there in order to be your stop.
Yeah, like that is your worst case scenario. And then in this case, a higher low. Okay, so this would be a potential stop. And so that's a good thing to talk about here. So kind of wrapping this trade up. So you would take your first entry here on, 19 October? Okay. When you take the entry until the day closes, your stop is low of day. Okay.
Okay.
If it closes and confirms, like it closes over your level and it confirms, okay, this was a true breakout. Now you can move your stop down to where it would have been originally, and it's down here 30, call it $31. So, and that would be how you base your risk. When you enter the trade, you're assuming my entry is going to be 33, let's call it 33.50 to $31. So basically you're assuming this is where your entry is going to be, and this is where your stop's going to be. And that's where you take your sizing. So that's, $2.50, figure out how many, a 3% weight, a 3% weight for your portfolio, risking $2.50 per share. How many shares do you need to buy to hit that 3% weight?
And so then that 3% at $2.50, that's 3% of your entire portfolio, or that's
yeah.
And that the risk is that not so much the shares are 3%, but the risk is that.
Yeah. So if you had a $10,000 account, 3%, you're risking approximately $300.
Yeah.
Right. And so then, okay, how many shares can you buy with $300? Right. So in this stock, this stock, it'd be about 10 shares.
Yep.
Okay. So that's what your risk would be.
Okay.
And that can work the same, that can work the same for options too. You can get into that in another video, but you can apply the same principle to options. It's a little tweak to it. So
sure.
But yeah, that's how we do HWM. Does that make sense?
Absolutely. Okay. And then you could also, if you wanted to add, you could add on a retest. Do you ever do that? Like a retest?
Yeah, absolutely.
You're getting held it, right?
Yeah. And so, on this one, this would be a good example of it. So HWM, and this is common with 200-day clears.
Hey guys, this video was a condensed look at a much larger strategy and a much more detailed piece of content. To get the full detailed version of this video, plus access to our daily live streams, a vault of exclusive content, you need to be in our room, The Construct. We're dedicated to helping you grow your portfolio. The Construct is dedicated to helping you not only grow your expertise and skills as a trader, but also grow your portfolio. So stop trading with half the picture and click the link in the description below to join The Construct for free. We'd love to have you.